Well, hello everyone, and welcome to the latest edition of Conversations with a Pro Trader. I'm your host, Greta Wall, and with me today we have an exciting new guest, Andrew Moss. Thanks so much for joining me today, Andrew. I know you go by Andrew, you go by Andy. Which would you prefer today for our conversation?
Everybody calls me Andy. That'll be
Okay, so
just fine.
we'll go with Andy for this. We can be on a casual basis here. All right. So, as since you're a new guest, before we get into our usual first questions here for the audience, I do want you to just introduce yourself. So, how you got into trading, how long you've been trading overall, how you found T3, etc. Kind of the Cliff Notes version of Andy as a trader.
Okay, sure. So I started a career on Wall Street just exactly 23 years ago, June of 2000. I went for Smith Barney as a retail advisor, and that was owned by Citigroup at the time. In my early training, our trips were to Manhattan. I went to 388 Greenwich was the headquarters, and one of the earliest impressions that I got there was the big podium up on one of the higher floors. I don't remember, but it was very big. We had the largest training class that had ever come through at that time. There was like 150 of us, and Luis Yamada, legendary technical analyst, gave us all a very nice presentation on a huge screen that showed some of our handwritten charts, hand-drawn charts, and lots of things about why there was a likelihood that the market was going to go lower. So keep in mind, June of 2000, the market had peaked 3 months before. Everybody was still high on the NASDAQ, and there might have been some boos when she said, "Look out below." I don't recall, but I remember that there was a lot of people saying, "Nah, the market's just going to keep going up." And so that left a big mark on me. I had always, my dad was an advisor too, and I remember from an early age, he would show me point and figure charts in the chart craft books. So I got an exposure to technical analysis early on, but in Luis Yamada's presentation, as I said, left a big mark. But I got away from it for a long time. You go through, learning to be a retail advisor and a financial planner and that kind of thing. And then that changed in 2009. At that point, when I'd gone through, what everybody was calling the second generational bear market of my short investment career, I was like, okay, modern portfolio theory is not the way. There's got to be, we got to do something different. So to try to keep this part brief, I made a switch to taking more control over client portfolios and started my journey as a portfolio manager, a discretionary portfolio manager for clients. And I knew right away that we had to have more stringent risk management policies. And that's what led me to technical analysis. Technical analysis led me to thinking like a trader. I learned about Dr. Van Tharp. I read one of his books. I started poking around on Twitter and trying to learn what other folks were doing because it wasn't a very widely followed discipline in our firm, or certainly not in my office. And so I was looking for other
Mhm.
people that, obviously one of the first people talking about this kind of thing on Twitter often was Scott Redler. And I started following Scott early on, and I thought, my first impression was like, why does this guy keep talking about the 8 and 21-day moving averages? What's the significance there? Because at that point, everything was the 50-day and the 200-day. You didn't look much more closely than that. And so Scott was doing something a little different, which interested me very much, which led me to learning more about T3. And I had never lost interest in that. Followed the company, followed what was going on, met Derek Oldensmith. And so in October of 2020, got an opportunity to make a change, and I immediately called Derek and I said, "Hey, what are you guys doing? Is there room? Are you looking for folks?" And we had a conversation. One thing led to another, and so I've been a professional trader with T3 Trading Group since October of 2020,
Mhm.
and that's where I'm at now.
Great to hear kind of a synopsis of your story, your professional story there. For everyone who is joining us live, I just want to give you a reminder, if you haven't been here, if you've been here before, and if you're new here, this is a Q&A event, not just between myself and Andy, but also between you and Andy. So I'm putting a comment in the live chat now to just so you can see where it's at to submit your questions. So if you submit your questions as Andy's talking, if there's something you want him to expand upon, or if something totally unrelated, ask your questions there. And then the second half of this event, I will ask him all of those. So we will get to every single audience question at some point in this event. We'll kind of have our own conversation in the first half here, and then audience questions at the end. All right, so Andy, on top of being a professional trader, you are also a chartered market technician. First, kind of explain for everyone what that designation means, how that differentiates you from just a regular old trader, and then why you chose to pursue that and how it has impacted your trading since.
Okay. Chartered market technician, the designation is kind of the other side of the coin to the chartered financial analyst, if you will. CFAs are fundamental analysts. CMTs are technical analysts, and so we think about kind of the dual approach there, or playing the piano with both hands, as some people like to say it. The used to be called the Market Technicians Association. Now it's the CMT Association is the sanctioning body. They are in charge of the educational content, the testing requirements, the association membership, and that kind of thing. And so it's a great organization, a great way to learn technical analysis, and just a logical, sensible way to solidify those credentials if it's something you're practicing. And so the way that I found that was to back up to the last question about how and why I was getting involved in technical analysis. I kind of always had a background or some exposure to it from an early age, and going through the process of becoming a portfolio manager for my clients, and really focusing on that sell strategy or that risk management discipline. That's really the primary function of technical analysis. It's a risk management tool above all else, in my opinion. Other folks may apply it in different ways, but I probably don't get too much pushback on that. It's a indispensable tool for measuring potential levels of risk, and formulating ideas and strategies to deal with that risk as it comes about. So I had gone through, as a retail advisor, I had explored a CFP designation. Accounting is not a favorite subject of mine. I don't like to study the fundamentals or any of that kind of stuff. And so none of those things really ever appealed to me. And so as I was going through and really trying to improve myself and think like a trader and a technical analyst, I thought, why would I'm learning all this and studying all this stuff anyway? Why wouldn't I kind of formalize the process and back it up with a formal education? And so I joined the MTA, Market Technicians Association, and started the testing process. And I was already so far in my studies. It's a 2 or 3 year program, and I knocked all 3 tests out in 13 months. And so it just, and that doesn't mean anything special. It just shows you that I was already committed to the process. So that's why I say this was just a logical, sensible step for me to go ahead and add that into the fold.
Mm-hmm. Okay, so now we'll get to what's my normal opening question for most traders who come on, or all traders who come on this event, and that is, how would you grade your week of trading so far? So that's on your typical grading scale, an A, B, C, D, F, and
okay. I'll probably give it a B this week. And I was on vacation all last week. So when I get away, I really like to get away. So I was able to get completely flat. I didn't have any positions to worry about, and I barely checked the markets all week. So coming back Sunday morning, I started going through my charts and getting caught up on the action of the last week and that kind of stuff. So when I do that, I find it serves me well to take my time getting back involved. I don't typically do so well if I just try to jump in with both feet Monday morning. Given the pullback in the market, I kind of said, let's hang on. So I would say it's a B because I haven't really done a lot, but it's probably an A in the sense that I stuck to my plan. My intention was to be patient, get the rhythm back, and wait for the opportunities. So I don't know, B plus, A minus, whatever you want to call it.
All right. Yeah, and for everyone listening, just notice that that B plus, that A minus isn't coming from Andy is saying he's made a ton of money this week. It's that he's followed his plan. He's done what he set out to do, and that's so important for traders to follow the plan. To minimize your losses, maximize your wins, of course, but it's not all just about how much profit you're making on a day-to-day basis. All right, so let's go to the news of the day today. Focus was back on the Fed today with Chairman Jerome Powell speaking at a panel in Portugal. He was speaking alongside a lot of other central bankers from around the world, but saying, quote, "We believe there's more restriction coming," and adding that the very strong labor market is what's driving that decision to hike further for the Fed. What are your thoughts on the Fed's current stance about monetary policy?
I might be in the minority, but I think they're handling things pretty well.
Mm-hmm.
They've got a very tough job. It's easy to look back and say, well, they should have done this. I think there's a strong argument to be made about why the Fed funds rate ought to just be pinned to the 2-year note, but that's a subject for another time. So, considering where they've come from and where they are now, I think they're doing what they have to do because the market is still very resilient. The rate hikes so far, despite all the best laid fears, have not tanked the market. Matter of fact, it's been a market for several months now that it just won't go down. Right? There's been some pullback and some pull in, but the Fed couldn't crash it. A banking crisis couldn't crash it. We still have pockets of things that look out of control, and I mean out of control to the upside from time to time. And so people joke about it on Twitter, but there's real examples in there too about, well, as long as XYZ is happening, the Fed has to keep raising rates, right? Money's too easy, and people are still taking kind of crazy chances on things, and combined with the strong labor market, I don't know if they will continue to hike rates, but I can understand why they have to continue to say that that's a possibility. That they're trying to project their intentions very clearly and very well in advance, which I think is, nobody wants a surprise. The market hates surprises. And so, given the situation, I think they're doing the best they can, and we'll see what happens.
Okay. So other news of the day today impacting one of the strongest stocks of the year, and that is NVDA. Shares dropping following a report about new chip export restrictions to China from the Commerce Department. Those, they say, could be in place as early as July. Company's CFO, though, downplaying the effect of those potential restrictions, saying there will not be an immediate financial impact to the company. So how do you feel about the market reaction to this news today?
Not surprised. The sell-off after hours, I think, anytime something comes out of the blue like that, it's going to catch a few people off guard. But look what the stock did, starting at 4:30 this morning. It's by the dip. He's talking about a market that just can't go down, and the strongest stock, AI, the strongest story, chips, the strongest sector. It doesn't surprise me at all to see a big whipsaw like that, and I think it creates a lot of opportunity, actually.
Great. All right. So this is the last week of the month, the quarter, and the first half of the year. Kind of an important week to bookend a lot of key timelines for traders and for the market. How would you describe the past month, quarter, and 6 months on Wall Street?
The last quarter has been, we finally have a market that feels like it's got some staying power to the upside. For months before that, or for the first quarter, we're like, all right, it's going down, but it won't stay down. We've had what is it, an 8 and an 11% correction so far this year. My percentages are off there a little bit, but it's been choppy until everybody was looking. I started writing about this probably in the fall of last year. The line 4,200 on S&P. Everybody was waiting for 4,200, and it actually, if anything, it may have surprised me a little bit. I thought the possibility of the FOMO trade kicking in much bigger once S&P cleared 4,200, and I think it did a little bit, but it didn't run away, which is good. It's been fairly orderly, it seems, and made pretty good sense. So, first 3 months of the year, very choppy. Very nobody wanted to believe the up moves. It was hard to build portfolios or take positions with any longer time frame. And since we've gotten up over S&P 4200, I think folks have relaxed a little bit. It's there's a lot more people out there willing to take a position and hold it longer, to build a bigger portfolio, to put more money at work with in a bit of a longer term time frame. And all of that combines. We see the stats too from some very capable technical analysts. Ryan Dietrich is a guy that's really good with the stats about not only seasonality but the tendencies. When we're up for the first 6 months of the market, we're very likely to have good performance for the next 6 months of the market. And so the first 3 months were hard. The next 3 months were better that we're ending right now, and everything seems to be lining up, at least from a probability standpoint, for a bullish end of the year for the next 6 months.
Uh, a key mark of a successful trader is one who can adjust to different market environments. And we've already had several different market environments just throughout the last 6 months. Lots of change happening in the trends that we've been seeing. So how have you adjusted your trading strategy throughout all of those different changes?
Probably the most impactful change has been getting back to options. I've utilized options a lot over the years. When I first started as a prop trader, I kind of got away from it in an effort to simplify and just focus on holding shares and kind of keeping things simple. Through the chop and those, what I was just speaking about with the difficulty and the raised anxiety and uncertainty around holding positions longer term, shorter dated options because the moves have been shorter, right? So shorter dated options and weekly options have been a great way to take advantage of moves that happen quickly. You can kind of magnify the power there of those moves and get a much more timely in and out, and your risk is limited the whole time. If there's another invasion, or Russia invades another country, or Lord knows what kind of geopolitical headline comes up, with options, your risk is always limited to your principal paid, and that's a comfort level that's aided my trading and helped me take advantage of the moves back and forth.
Nice. As we kick off a new quarter of trade officially on Monday, what are the key levels that you're monitoring right
now? 43.25 on the S&P, I think is that's still a good level. We kind of pulled right back to that pivot, and that's where we're trying to bounce this week. And so I think it's important to consider the staying power there. The 430 on I was talking about the S&P 500, but if you look at roughly 430 on SPY, that's kind of that's the pivot level that coincides with the 21-day moving average, and so far that's holding. I think that's going to be important going forward. If we lose that, then we're back down to 420, and that's going to be a really big spot, because we bumped up against that so many times. Everybody was watching, and there was several false starts, and we finally got over, and everybody kind of breathed a sigh of relief. If we dip that low again, which SPY 50-day moving average is just over 420 right now, if we were to lose that level, I think that would bring a lot of anxiety back into the market, and could be a great buying opportunity, but it also could scare a lot of people away. So I'll be looking at 430 first and 420 next, and then on the upside.
Real quickly, we do have a SPY chart. Do you want to pull that up and kind of talk through this with
go ahead
the chart?
And pull that up.
All right. Chart is up. All right, so you can talk through that, so people can just kind of see what you're talking about.
So you can see the red candle there, 3 candles ago. That's Monday's action as we came down into the 21-day in that 430 area. There's a pivot back, and I think the chart's got the line on it there. That was a 431.73 back in August of last year. So that's there's several things there that tell us that 430 should hold. If it doesn't, then we're back to you see the 50-day there around 420, a little above 420, and that was the level that's had so many eyes on it for such a long time.
Mm-hmm. All right. Let me find all right there. Okay. So, as a chartered market technician, what are your favorite charting tools when, like that chart we just showed, you're creating charts throughout the day to aid you in your trading, but also to help the community of traders that you work alongside at T3. So what are the tools that you're relying on a day-to-day basis?
Well, but most of them are right there on the chart that you were just showing. I've got the 8, 21, 50, and 200-day moving averages. I use those as, and Derek, he's probably said it on this show. I'm sure he has, and he told me early on, the 8 and 21-day, if you consider the space between that as kind of price equilibrium, that's kind of where the price wants to be. And so when we get to that, those are good gauges of short-term momentum, either bullish or bearish, and as we get extended away from those moving averages, that tells us that maybe things need to cool off a little bit if they're to the upside, or maybe the selling needs to slow if it's moving down. So that's a very good gauge of short-term strength and momentum. The 50 and the 200-day are kind of industry standard. Most investors are considering the 50-day and the 200-day as their positions are tracking along above or below that. Very common for people to say that above the 200-day is an uptrend and below is a downtrend. So to keep it very simple. So it's important to know where those are. And it's mainly, the main importance is because there's a perception that so many people are watching this. Everybody looks at a chart, probably has those moving averages on there. And buying does come in at those levels sometimes. It's not a guarantee. It's not an end-all be-all, but it's just a piece of the puzzle. The other thing I have on there is the Bollinger Bands, which is if you think about a standard bell curve, and stock prices are not normally distributed, meaning they don't fall in a normal distribution, but they pretty much do. I can't explain the differences, and nobody cares to hear about that right now anyway. But the idea being, most of the time, most of the move is going to happen within those Bollinger Bands. It's a 20-day move, usually a 20-period moving average with a band on either side, plus or minus one standard deviation there. So those are very useful to me to look at the strength of the trend. If you still got that S&P chart up there, you can see for the last month or so it was pushing that upper Bollinger Band up consistently. It's above the 8-day moving average. It's pushing the bands up. All of those things tell us that the trend is strong and likely to continue. So that's a tool that I have on there a lot. The relative strength index is another tool. That's just what we call an oscillator. When it's to keep it very simply, above 50, it's well, let me back up. It goes from 0 to 100, and so if you delineate that by the upper half and the lower half, move on the action on the RSI, the relative strength index, in the upper half is generally considered bullish, and on the lower half bearish. So that's another thing to keep an eye on for me. And many others. It helps us gauge the strength again and levels of extension. If something gets a very high or an abnormally high RSI reading, that can be an important piece of the puzzle. Again, not an end-all be-all. None of this stuff by itself is, but I kind of consider these things as building a case, or where does the weight of the evidence lie? And so those are they all work in combination there. And then the last thing, and it's not on the chart that you have pulled up there, but something that I use very regularly, is the anchored volume weighted average price. And that's something that it's been widely popularized by Brian Shannon. He's written books on the subject. He's taught me everything I know about it. And it's just a really interesting tool to me. You can anchor it to events, earnings reports, news headlines, year to date, week to date, month to date, quarter to date, any of that kind of stuff, large gaps, anything like that. I find that if you use that, it very often shows some meaningful turning points and potential support and resistance zones that are nice to keep an eye on.
Yeah. All right. I have a few more questions here, but just a reminder for our audience that the chat is open for you to submit your questions. We do have a few questions already lined up that I want to go ahead and switch to now, and then we'll kind of bounce back and forth. So
Okay.
our first question comes from Eddie, and he asked, as a newer trader, what were your biggest hurdles to overcome before you found yourself as a profitable trader and became consistent?
Hey Eddie, thanks for the question. I'll tell you the biggest thing I had to learn early on was not to try to stay so busy all the time.
Mm,
Making a leap from a portfolio manager with other people's money that's generally very long term in nature. Um, that's the kind of thing where you know it's hands off a lot of the time. When you
mm,
jump into full time trading for a living, you want to work hard, right? And when you show up to work, you feel like you need to do something. And so over trading is a big trap that's got to be dealt with early on. And so that was one of my early challenges was learning how to sit and wait. It's like, all right,
mm,
listen, you don't. There's nobody breathing down your neck. Nobody's saying, okay, you've got to do X number of trades or trade X volume or something that kind of stuff. That's not how it works. You've got to be patient and wait for the right opportunities, and it's even more important early on because you can't do everything, right? And you've got to find a thing like what's the one setup or what's the one trade that you can find and identify repeatedly that you're good at and what works for you. And so
mm,
don't overtrade and don't try to do too many things. That coupled with, and I have to laugh at this a little bit because the stats went around. I went from a long-term portfolio manager to a professional trader where I was learning to day trade. I was learning to deal with the much shorter time frames, and I started in kind of the I don't know, was it the middle? Was it already in the back half of the meme stock craze when everything was going bananas and there was
mm-hmm.
crazy moves and all this kind of stuff? And so here I was trying to learn to day trade, and like something like 65 to 80% of the moves were happening in the overnight market. And when I wasn't keeping positions overnight. I wasn't building big portfolios and letting them sit because I was very focused on making sure I had good risk management and didn't want to have big gaps down and all that kind of stuff. So that was kind of a looking back, kind of a funny thing to reckon with was trying to work in day trades and short time frames, and all the moves were happening in the overnight session. So I don't know that that's helpful to answer your question, but that's just a funny thing that pops up as one of the challenges that I had learned to deal with.
Yeah. So you've gone from being a portfolio manager to trading on your own into now trading prop with T3 Trading Group is the firm. So talk to me about the transition from trading on your own to trading with the firm and how that has been beneficial to you as a trader.
Oh my gosh, I can't imagine doing this on my own. I know a lot of people do it. It's not impossible, but the resources, the community, the camaraderie, the help that comes with T3 Trading Group is phenomenal.
Mm-hmm.
Derek was a Derek Olden Smith who I started on the ProDesk VTF with Derek and Pat, and I'm still in there every day. I'm not as active in that group as I once was, but he taught me so much about how to navigate the markets on that short-term time frame, how to formulate your game plan when you're not looking at weeks and months very often, or at least not all the time. What happened yesterday, and how's that going to affect today, and who is there a Fed speaker? Are there earnings reports? All these kind of things. And so he was, and everybody in the room. There was just a lot of really good support and really good help. Not to mention the educational materials, the online classes and courses that are available. Just very, very, very helpful. If anybody is like really trying to do this and really make it go, you've got to find your community. You've got to find your
Mm-hmm.
people that you can bounce your ideas off of, that can criticize you or give you constructive feedback when you're wrong, kind of coach you along the way. It's a very important part of the process.
Right, totally. All right, we'll continue with some audience questions. Our next question comes from Hunter, and he asked, what are the absolute basics of technical analysis that you feel everyone should have a firm grasp on before seriously trading?
The most basic tenet of technical analysis is probably support and resistance. That's um, you look at previous price levels, and I believe the price does have memory. Pivots are important. We do see things happen repeatedly at similar, if not the same levels. It's not always exact. It's not always to the penny, but it is something to be aware of. And if you think about it like this, and I'm going to take the time frame back down to kind of intraday again. Suppose someone's got a huge position of Apple stock, or pick the company. It doesn't matter the company, but they've got and they've gotten orders, or they've got an idea that they need to liquidate that position. Maybe it's millions of shares, maybe it's tens of that, whatever it is. And they, anybody that's selling, they want to sell at the highest price possible, right? And if they put that whole position out at one time, it's going to flood the market, and price is going to go down, and they're going to hurt themselves. So they try to feed it out at a long, over time. So think of the intraday VWAP. Think of a price that you've watched bump up against the level 100 times and get rejected every time. It could be because and you can see this on the tape. It's another thing Derek teaches a bit about is tape reading. Is you can see some of the orders from time to time, and that there's someone there that they've got shares to sell every time it hits that price they want out. So anyway, that might be a little off topic, but it just kind of a real world example of a resistance level coming into play and kind of keeping that price down. And so when that seller is gone, when he's done liquidating that position, and the price gets back up there, and he or she is not there to sell, then that's how breakouts happen. And so that's how you can see that that price level change then from resistance to support. And the same thing happens on the way down with buyers trying to build a position. And so whether you're looking at an intraday time frame or a daily chart or a weekly, whatever, you always have to consider what the other market participants are doing. And the best way, in my opinion, to know that or to identify that is by looking at the chart, because whatever, put your money where your mouth is, it's all showing up in the price action. We don't always know the reasons, but we can see the things that are occurring. We can look at those support and resistance levels and use them to our advantage from time to time.
Mm-hmm. Our next question comes from Shane, and you actually did address this briefly, but we'll expand upon it. So he said, Andy, have you implemented any work with Brian Shannon's work on anchored VWAP? I recall you thinking about that a while back. So perhaps adding a VWAP from an event or a recent lower top. What are your thoughts?
Absolutely,
so how have you
Shane.
been using it, and how has it changed your trading at all?
Okay, here's a recent example. You've got Greta. You've got an NVDA chart that I sent over to you. It's a 30-minute chart. If you want to pull that up, I'll give you a great example here. And excuse me while I look at it over my shoulder here just to refresh my memory. But if you look at the orange line on that NVIDIA chart, that is the VWAP anchored to the earnings gap. And just on Monday, we saw that there was selling and the price came down to, and you're looking at the 30-minute chart there, and notice where it reversed. It dipped below that orange line, that earnings anchored VWAP. It put in a hammer candle, and then it started going back up. It found buyers. The average shareholder, they were back to the average price, and so buying resumed, and the price bounced again. So that's just an example of it in action. Whether it's an earnings event, a specific point in time, whatever it is, I'm constantly fascinated by the accuracy of those levels as they come up. So, and Brian Shannon will tell you, and he writes in his book, it's not a guaranteed place to do business. You don't just look at the line and say, all right, I'm buying once it gets here. And that's not, that's not my tactic. But when it dips below and then comes back up, and you see that buying happen in real time, that's a signal, and that's sometimes an actionable item that you can use to your advantage.
All right, great. Our next question comes from Billy, and he said, you mentioned getting back into options. Is there any strategy you go to more than others? Are you trading spreads much?
Hey, Billy, good question. I used to really like bull spreads and bull call spreads and bear put spreads, because they limit your risk, they take your costs down, you still got good participation, and I think there's still a place for those. I have not been using them as much because I think they make more sense for kind of a longer dated strategy. If you're looking out probably a month or more, that I think there's good use for spreads. And something that I learned later in my options trading experience was that you can, a bull call spread, you can kind of think of it as a covered call. You've got your stock position in the long call spread. You sell the short call, or excuse me, you've got your position in the long call. You sell a short call higher up to make it a spread, and it's like having a covered call position on the stock in some ways. And so you collect that premium. And I know folks that do calendars, or I'm not sure diagonal is the right word. It's a calendar where you own that long call, and then you sell the short calls against it repeatedly. So if maybe you have next January's calls, and so you might sell the higher strike call for July, and then if it expires, you might sell it again in September, and so on and so forth. So I think that's a strategy that makes a lot of sense longer term. Lately, I've been using weekly options more, as I alluded to a little bit earlier. And this is something that's really developed as I'm spend most of my time over in the inner circle now with David Prince and Rick and Kira, and David's really good at identifying these opportunities in the weekly calls, and that's something that works out. And there's just not, when you're looking at short dated options like that, there's not only is there not a need to complicate it with about turning it into a spread, but very often you can limit your upside with that too. And so that's just not something, I'm keeping risks small. We're buying options that aren't, they don't have a lot of time. So the cost of the option is typically not very high, or not as high as, a 1 week option is not going to cost you nearly as much as a 6-month option. And so the funding is not an issue. It's not as expensive. It doesn't take as much buying power. So on. Anyway, you get the point. And so no, I haven't been using spreads. I've just been using just plain vanilla calls and puts for the most part.
All right, got a comment from someone saying he what you were talking about also has a nickname, a poor man's covered call.
Yes.
Yeah. All right, so our next question comes from Shelly, and she asked, what do you attribute more to your success, charts or fundamentals?
I would have, if I have to pick one, I would say charts, because I'm not a fundamental guy. I can't tell you the PE of probably any stock that I'm holding. I don't follow the earnings reports that well. I'm not so interested in the earnings as the reaction to the earnings. And so charts have definitely had the bigger impact. When I was managing portfolios, I relied on company research. We had some good analysts. It's a hard thing to say sometimes as we get ridiculous price targets and upgrades and downgrades years after the fact, it seems. But anyway, you got to have some fundamental skin in the game there. So finding a good fundamental story and matching that with a solid chart and a good trade setup is really that's the cream of the crop there. That's what you really want to do. And so I don't follow those fundamentals. I use outside sources for that. Whether it's an analyst you really like, whether it's somebody that's super smart that you trust and know, however you do it, I do think it's important, but it's certainly not my strength.
All right. Yeah, definitely as a chartered market technician, I'd say charts are your bread and butter when it comes to trading. Shelly said, thank you for your answer. All right. So our next question comes from Eddie, but a different Eddie than the Eddie who asked our first question. And he said you made a good point on not over trading and risk management. He wants to follow up and ask about your way of controlling the portfolio with proper leverage. What type of indicators do you generally look at to prevent overexposing your positions? Would tracking portfolio Greeks daily be a good way to gauge the risk of your portfolio?
Did you say tracking portfolio Greeks?
Yes.
Okay. Now, I rarely look at the Greeks on options. That's over my head largely. Implied volatility, which there's a fancy Greek word for that, I believe. I couldn't tell you accurately what it is. That's something that we do look at, that I do look at to judge how cheap or expensive an option might be. But I don't look at Greeks, and I can boil it down to position sizing. You know, you can Google position sizing. I've written about it. A million people have written about it. It's on my webpage. It's anywhere you want to look at it. Just learn how to size your positions and monitor your risk that way. Where's your purchase? What's your stop? How bad are you hurt if you get stopped out? And it's as simple as that. And if you're doing a very standard 1% portfolio risk per position, and you have 10 portfolios, if the market tanks tomorrow and you get stopped out of everything, you're down 10%. Are you okay with that? That's the way I look at it. And that way, it takes some of the guesswork out. You don't have to worry about things like, all right, I've got $100,000 portfolio and I've got $250,000 worth of stock or whatever. That's a ridiculous number, but you get the point. That would drive most people crazy. Or maybe, to take that back to more realistic. Let's say you got a $50,000 portfolio, and with buying power, you've got $50,000 worth of the Qs or something. That a lot of people would just, like, their head would explode. They'd be like, "Oh my God, I can't." I've always been taught don't put everything in one basket. Well, you're not holding that to go to zero. If you've got a 1% exposure before your stop order is in, or your mental stop, or however you're doing it, then that makes that a workable transaction in your mind, and you can know that, okay, even if the market tanks, I have a stop in that should protect me, and I'm only down 1%, and I can live with that. That's the kind of thing that you really got to focus on. If you really want to dive deep into that and get super nerdy, read Van Tharp's Definitive Guide to Position Sizing. It's got more than you ever could care to learn about it. It is the Bible for position sizing. It's got a lot of really good info in there, but to keep it simple, that's the basic way that I look at things.
Yeah, great. All right, we have another question from Shelly. She said, the market has broadened out and providing some big trading opportunities in smaller names. Did you have any large wins this month in small mid-cap names that have great charts?
That's a great point, and we were just talking about this in the VTF, the Inner Circle VTF earlier. David was pointing out and asking the question about, or more making a point about, why is it important to see the market broaden out? And very simply, it's because it means there's more opportunity. When there's only 7 stocks going up, if that was ever actually the case, then it's harder to find things that you can buy and make money on, right? So when you start to see things going up, and to answer the question, yeah, we've had a lot of trades in there from smaller companies. And just look at this week, AI, Marathon Digital, to name a few.
You have charts for both of those. Do you want to address either of those charts?
Sure. Yeah, go ahead and put one of them up there. You can look at, let's, I don't know, take your pick. I don't care which one.
We could do both. We could do AI first, okay, and then Marathon second. All right, so AI is up.
So this is a smaller company, and obviously the name lets you know what they're in, and that's there's been a lot of movement there, and if you're able to get in sync with those fluctuations back and forth, that's been one that we've been very active in, and it's served us well. So that's a smaller company there that's.
So when someone's looking at this chart, just talking through the chart, what are the things you see on this chart that signaled, a buy, and, all the things that made you guys get into it?
Okay. All right. Let me walk you through just a sequence from this week. You can look at and see, if you look straight up, the highest point there on this chart is last Friday, right? Or excuse me, that's 2 Fridays ago, June 16th. And the stock made a high and it went straight down for 6 days. And so the conversation comes up, and we're looking through our morning, and David says, hey, this stock's gone down 6 days in a row. What's the likelihood that continues? And so he starts looking at that. We start talking about it. We're looking at some potential support levels there. If you can see the lightly shaded area, there's a pivot zone there. Prices come up to go back to that resistance that we were talking about earlier. Prices come up a few times. For whatever reason, sellers jumped in and pushed it back down, and it did that since February. A couple times there in April, it poked over it briefly, and then it went back down very quickly. And so it's revisited that area. We know that for whatever reason, and I don't even care the reason, but that price level has significance. So combine that with the fact that the stock is sold off for 7 days in a row, 6 days in a row, and then you look and say, okay, is there a chance that it could break, turn around and go higher here? Sure looks like it to me. We sure thought so. Is there a chance that it could go lower and touch the 50-day? Absolutely. That's why position sizing and risk management is very important. But that just to kind of give you the life cycle of a trade there. That's the identification. That's how we looked at it, and it's had a nice couple of days.
Great. And then what about Marathon? I pulled up that chart for you as well.
Marathon Digital is that's a Bitcoin proxy, and this is one that again I post a Bitcoin chart almost every day. I've been looking at it for months, and I didn't send you that chart, but just to recap briefly here, Bitcoin has been tracking along this sub 30,000 level for months now, and it's been over briefly and it's been under briefly, and we were watching it, and again the kind of market that just wouldn't go down. Last week, a couple of weeks ago, it hit us what looked like a potential support level, and then it just started going up. And so when Bitcoin starts going up, you buy Bitcoin or you look at things that are directly related to it, and that was Marathon Digital. And so to get back to your Marathon chart there, no coincidence, it started going up just about the same time that Bitcoin did, and that was a good opportunity. We were able to take advantage of that. Excuse me. So that was another smaller company that's been meaningful here recently.
Yeah, great. I think to just talk through those charts and show people, what you were seeing as a trader who relies on charts for your positions day in and day out. All right, so we'll get back to some of my questions for now. Kind of we have a little over 10 minutes left here. So everyone who is watching, kind of your last call to get more audience questions in. I think this has been a great discussion so far. I'll ask a few questions to give you some time, but go ahead and submit those questions. It's my kind of last call. All right, so Andy, I'm going to ask you, what stocks are you bullish on right now and why?
I'm a relative strength guy. That's how I manage portfolios. Touching on an earlier question about one of the main tenets of technical analysis is, stocks that tend to continue to trend. It's a bit of a tongue twister, but you get the idea.
Yeah.
And so I'm bullish on the things that are going up. AI is the biggest story out there right now. You keep hearing things like AI is going to change the world in bigger ways than the internet changed the world. I don't know if that'll be true, but I think there's a logical case to be made for that. It's certainly getting a lot of attention right now, and like the AI stock that we just looked at, like NVDA we looked at earlier, keep talking about AI. That's a huge story that is continuing to move prices, and something that I want to continue to focus on. I'm watching the leaders, the tech stocks, the chip makers, the computer makers, software packages, cloud services, all of that kind of stuff is going to get probably much more important. Again, I'm not a fundamental guy, but I think that's going to get much more important. And the charts, those are the charts that are going up very strongly right now. So that's where I will continue to look for opportunity primarily.
All right. And then on the flip side of that, what are you feeling most bearish about right now?
Bearish,
and if there's nothing, then there's nothing. It's fine.
Okay, so it's I've got things in mind, but it's not that I'm so bearish on them. It's just not where I see the better opportunity.
Okay.
It's hard to be too bearish on financials because they're still hanging around despite the banking crisis of recent events. So it's not that it's terribly bearish, but I don't know that I want to be jumping in to buy very much stuff right now. Commodity, energy, with the exception of some uranium names like oil companies and that kind of stuff, they're just kind of not doing anything. You look at the price of a barrel of oil or the commodity index, it's just kind of rolling along flat to down. It won't break down and go lower, even though the chart looks like it should. But it's not going higher either. And it may, who knows, it might do like Bitcoin and turn around and jump straight up tomorrow for all I know. But right now, that's not the kind of thing that I'm focused on because it just hasn't been participating as well as some of the other stuff.
Yeah. All right. Tell me about the best trade you've had this week and what made it go well.
Mara, the chart we just went through.
Okay.
That's my best trade of the week so far, and for all the reasons that we just identified.
Yeah. And then on the flip side of that, because we talk about the realities of being a trader here. Tell me about the worst trade you've had this week and what made it go wrong.
Um, Again, one that we just went through, AI.
Hmm.
It's my worst trade of the week because I wasn't in it.
Hmm.
I watched that opportunity walk right by without me participating, and that goes back to my plan that I set forth early in the week. So take it easy, don't do too much. That's the downside. That's the opportunity cost of having that mindset, and
Hmm.
that's going to happen. So not worried about it. But that's AI. Actually, AI and MDB is probably a tie for those because those are two trades that have worked out very well that I simply wasn't involved in.
Hmm. For a lot of less experienced traders, they can get into a situation like that, looking at AI, looking at MDB, and saying, "Oh, I missed it," and getting the FOMO, that trade, and then maybe possibly getting into a position that they might not should be in. How do you avoid falling into FOMO as a trader at this point in your career?
Hmm. There's no easy answer to that. Some people use a checklist, some people use a scoring system, some people, whatever it is, you just have to have awareness of the tendency to fall into that trap. You have to
Hmm.
know yourself as a trader. You have to know, and the tricky part is that sometimes you've got a trade on and then you look at it 10 minutes like, what did I do? Why did that happen? Or why am I even in this? Fortunately, that kind of thing doesn't happen to me very often. It happens some in the beginning stages, but there's a balance between getting in the zone and being very focused and getting on cruise control and
Hmm.
getting complacent. And that's a thing that's got to be balanced very well. You can't get complacent and you can't just let yourself be lulled into trades out of boredom or FOMO or whatever it is. And so figure out how to identify when you are more susceptible to that. We probably all have cues. A poker player would tell you, there's a tell somewhere. You've got a tick, a nervous habit, something. Um, you've got to identify that tell and formulate that mental alarm bell that says, "Hold on, don't act yet. Make sure this fits your plan. Make sure you're not trading out of boredom. Make sure you're not reaching too far." And can be a very hard thing to do. So make sure you spend a lot of time figuring that process out.
All right, and kind of wrapping things up here, we're halfway through this week. We have two trading sessions left, and then we have a holiday in the middle of the week next week on Tuesday. So, you get to trade on Monday, take a break on Tuesday, come back on Wednesday. Talk me through your plan for the next, what is it, six trading sessions for the next week.
Um, I'm probably going to continue to take it pretty slow. I'm still
Mm-hmm.
getting the rhythm back. I'm still watching this pullback and see. Yesterday was a good start on SPY and QQQ, bouncing from the 21 day, getting back over the 8 day today. And then, late in the afternoon, it was looking a little iffy. Like, all right, we've traded on either side of the 8 day in SPYs and Qs. Can this bounce really hold? And then we had a nice little push there at the end of the day. So you notice my position disclosure there. I've got SPY and Q as well as a couple other things. So that's I won't say easy, but that's a simpler way for me to start getting more involved
Mm-hmm.
when it's back over the 8 day and over yesterday's high. Maybe this balance continues, and if so, I want to be involved in that in some way. So that's something I'm looking for. I do think it's we're not out of the woods yet, not to sound overly bearish, but that's there's every possibility exists that we could dip back below the 21 day and correct further, and so we got to be ready for that too. So I'm going to continue to take it kind of slow, wait for, and it's been this way for a while. And David reminds us of this in the VTF every day. It's been a less is more market. Do
Mm-hmm.
fewer positions, maybe a little smaller size. Wait for the really good setups, and just take those few trades when they come that are that really look good, really fit your system and your style well, and just don't try to overdo it right now.
I want to go away from this with some suggestions for people from you. So earlier you suggested a book to read for position size, and Somebody asked what that was, and I'm confirming I got it correct. The Definitive Guide to Position Sizing by Van Tharp, correct?
That is correct.
Okay,
And
so
I
that's
have to
a
give a disclaimer
recommendation.
there.
Huh?
This is not leisure reading. It's a commitment. If you not
Yeah.
only is the book very expensive, you got you got to really want it
Mm-hmm.
to read through that book. It's very
Yeah.
good, but it's very technical.
What other pieces of material would you say are kind of essential for maybe a newer trader or someone who's looking to learn learn more about
Yeah.
the key parts of trading?
For the newer trader, to cite another piece of Van Tharp's work, that the first trading book, the first real trading book I ever read was Trade Your Way to Financial Freedom. That's a good primer to introduce you to lots of trading mindset concepts. As a matter of fact, he calls them Tharp think in the book. These are things you've got to understand: position sizing. You've got to understand how you think about risk as R value and reward as R multiples. You've
Mm-hmm.
got to have some knowledge and some background about how to create a trading system that fits your personality. All that kind of stuff. Trading in the Zone by Mark Douglas is another great one. The psychology and mindset is the most important part, and it will be. It's not the technical chops. It's not knowing the market. It's not knowing how to read a chart or how to properly push the buy and sell button. Those are hard skills that, and I mean hard skills as in the repeatable. You can train a computer to do them. Those are the things that everybody learns. It's how to have the proper mindset and psychology um, to act on all that stuff and keep your calm while you're doing it. That's a thing that's got to be studied. So Van Tharp spends a lot of time talking about that. Mark Douglas's Trading in the Zone is a great book for that. Um, so those are a couple of good places to start.
Great. And then for your more experienced trader who, maybe they've already developed their trading style and their strategy, but they're looking just to expand their knowledge, what would your recommendations be for that trader?
Come spend some time with us in the inner circle.
Okay.
Um, or check out the Pro Desk or Redler's Room or whatever it is.
Mm-hmm.
You've got to find some people that can help you get to the next level. Um, and David and Rick and Kira they've been fantastic at that for me. They've been fantastic at that for a lot of people. So come check out the inner circle and get an idea for how the experienced pros do it.
All right. Thank you so much for joining me for this event today, Andy. I really enjoyed our conversation, and I think the audience did as well. So, again, thank you for joining me. And for
Thank
the
you for
audience,
having me.
yeah, yes, it was great. For the audience, we will be on a break next week with the 4th of July holiday. I will be taking the week off. So, we will be back on July 12th with our next event here for conversations with a pro trader, T3 Trading Group's Josh Leffler. Will be joining me for that. And he's very active in the Pro Desk virtual trading floor, which Andy has mentioned a couple times here. But again, thank you, Andy, for joining me, and thank you to the audience for all of your questions today as well.
Thank you, Greta. I really enjoyed it.
All right, thanks.